sheet. Okay, has anybody started to put together their portfolio? Yes, no? With your sector weights, kind of the style of your portfolio, did you look at some mutual funds and some ETFs to see how they were constructed? Did you read about, how do you construct, a portfolio? What's a REIT? What's an ETF? What's an exchange traded fund? What's a mutual fund? Are you guys talking to each other? Are you ignoring each other? Are you communicating with each other? Okay, good. So they're broken up into sectors. Okay. So those were the companies for the tech sector. We got companies from 1 to 25 with their domiciles all in the United States. You got the industry sectors. You got your ticker symbols. You got the stock price as of January 1st. Okay. Then you have to come over here and you got to put in the market cap. Okay, what's the market cap? What's the market cap? We're using market cap. Can I use assets? As a scaling factor, I can use assets. What's market cap? How do I calculate the market cap?
Shares times price.
Yeah, so I can calculate the market cap of the equity by taking the shares outstanding times the stock price. Is there another way to calculate the market cap? Can I basically take the value of the market value of the debt plus the market value of the equity and get the total market cap?
Yes.
And use that as a scaling factor? Yeah. What we do is we put in the market cap. These guys wanted to use the market cap of the equity. You could use the assets too. And then what they did was it summed it up, divided it back. Okay. And it gets the weights. Okay. And these weights here, they match. Okay. But what they wanted to do too is they wanted to limit their exposure. They didn't want any one stock to have, in this case, it looks like no more than 9%. I would probably move it to 12. So like, Alphabet and Amazon and Apple, they're approaching market caps of $1 trillion. So if this was an unconstrained portfolio, those three companies would have the majority of the weight within the portfolio, so you're not really getting any diversification. So what they did was they took down manually, they took down the market caps for the big companies, and then they brought up the market cap for the other companies, so that the smaller market cap companies got at least 2% allocation within the portfolio, so they set a minimum. And then they reduced the ones that were big, and they just played with this, these market caps to calibrate the portfolio to bind and set maximum and minimums. Boom, got it, done. So then you take the individual percentage, multiply it by the hypothetical $1 million portfolio. It's going to give you the total value that you're going to invest in that company. You take the value, you divide it by the price of the shares, you get the number of shares that you need to buy to gain that initial exposure. This is a very simplistic back testing method because we don't do cumulative returns, which means that we're reinvesting the dividends. We're not doing quarterly or biannual or annual rebalancing. It's just you come up with the initial shares, and then you go back 1, 3, 5, 10 years and see, what your returns would be if you bought that number of shares 10 years ago. So the first year back test, we went back 1 year, and that's all you have to do is just put in the January 2019 prices, bam, it's going to calculate the annual return. And then you got to calculate the annual return from the S&P 500. You subtract the S&P 500 from your portfolio return, you get the alpha. Okay. And then you have to, for the 3-year, you put in the share prices from January of 3 years ago, calculates the average annual compound growth rate. So here's how you calculate average annual compound growth rate. So there's the equation. So you're taking F32, dividing it by F31, taking it to 1 divided by 3, which is, 0.33. So you take that ratio, take it to 0.33, subtract the 1, multiply by 100, you get basically the average annual compound growth rate. You guys need to understand how to calculate an average annual compound growth rate. You just can't take the percentage change over a 3-year period and divide it by 3. That doesn't cut it. It's not going to work. Okay. So you get your portfolio return, average annual compound growth rate, minus the average annual compound growth rate for 3 years for the S&P 500. Subtract and get the basis points in alpha. Okay. So I guess they did a pretty good job of picking their stocks because, the alpha's pretty strong, but a 1 in a 3 year back test doesn't really say anything. You really got to go back 5 or 10. But the problem is, if we're doing January of 2020, what was 10 years ago? Yeah, 2010. What's happened between 2010 and 2020 for the stock market? Yeah, what's happened to the stock market?
It's only gone up.
Yeah, it's only gone up. So you've only been in the recovery peak phase of the business cycle. You don't even have the recession, so you don't even know how your portfolio is going to do under a recession scenario. So it would be probably smart to go back 15 or 20 years if you can to really back test it and see how resilient these companies were. Some of the companies, if you pick mid-cap or small-cap companies, they don't even have 15 or 20 years, price data. So you're going to have to, look at the trend and then discount the stock price back, right, to project backwards where you think it would be, 15 and 20 years, or run the correlation of the stock prices or the stock returns with a peer that has the backtest data or historical data, run the correlation, and then multiply the correlation coefficient against the, the subject company that you're using to get the, the company's returns to go back in time. So you're going to use somebody else to basically go back in time. So I usually pick companies that have historical data. This is part of the problem with this back test. And then you go back 5 years. And again, you calculate the average annual compound growth rate for your portfolio for 5 years, which is 1 divided by 5, exponential. You got your alpha, you're still kind of kicking butt on this one. And then the last is the 10-year. And that's the one I really look at. Historical performance is not a prediction of future performance, but I like to look at the 10-year average annual compound growth rate, both for the portfolio and for the market, to get a better picture of what the outperformance could be. So I think they did a pretty good job, of picking their stocks, picking the sector allocations, and then over here on that main master target portfolio, they took these weights and multiplied it by the beta and calculated a weighted average beta for the portfolio. So they're getting really good returns at a beta of less than 1. So their risk on the portfolio is less than the market. And they're generating alpha. So these are some pretty good companies that they selected and they researched and put into the portfolio. So that's the first, and you should be working on that now. You should start constructing that portfolio. And then the next sheet, we're going to do the first one first and do a passive portfolio report. And you have an example of that. Passive portfolio report, this one. I'll pass that around. And it actually even has the memo in it too. So you're going to write up this report. There's your, your spreadsheets. And then here's the PowerPoint presentation that you're going to make on the first product that you developed. Okay? Very simple, passive portfolio. The second portfolio, this is the optimization worksheet right here. So that's the one you want to pull. You guys want to pull this stuff up. Okay. So this one's a little different. And what I would do is I would not pull this into Google Sheets and start sharing it. You're going to blow up the macros if you do. Okay? So designate somebody who's got a 365, Microsoft, at least 10 operating system to be the master of the spreadsheet. And I would have one person be the master of the spreadsheet, because when you have other people working on it, they're going to totally screw it up. Okay. So this one's a little bit different. So this is, this stock portfolio optimization. Who's the portfolio manager? Okay. So this one's a little bit tougher. So these are the 25 stocks here. These are all calculated here. And I'll show you the data. And then later on I'll walk you through how to do this, but we're not there yet on this one. And then what you're going to do, I have 2018, but this should be 2000. You can use 2020. Okay. And then what you're going to do, this is what I did, is I said, okay, over the last 5 years, the mean and the median, annualized return for Apple was around 22%. Okay, so that's pretty amazing, isn't it? Yeah, that Apple's average annualized return over the last 5 years has been 22%. Don't you wish you would have bought like, $1,000 or $100,000 of Apple? You'd be a freaking multi-millionaire by now. So then what you're going to do, based on your research and what you've read about the company, the historical performance, is what you think, what rate of return do you think, just capital, appreciation on the stock price, do you think that the stock is going to do this year? We're in, we're like February, so we can do this year, or we can go through to February next year. So what do you think Apple's going to do? 22 or maybe 12?
12, they're manufacturing in China.
Huh?
They're manufacturing in China, but that slowed down, so.
Yeah,
less.
there you go. So it's probably going to be less than what's been running. So let's say 12. Okay? And what you can do is you can look at the Apple stock price appreciation currently, right now, or maybe for the first month of 2020, and multiply by 12 to get a run rate. And maybe in 3 months, you calculate the price change over the last 3 months from January to March 30th. So you get a 3-year, percentage change, multiply it by 4 to get the 12 month. So you can use the percentage and then multiply it by whatever to get an annual number. So you can do that too. And then IBM's been sucking wind. So I gave it 3% just to give it an inflation rate. Microsoft's been doing good. I mean, if you look at the chart, it's just been going straight up for the last 3 to 5 years. I didn't think it was going to do 22%, so I brought it down to 15. Oracle, they've done like 22%, so I brought it down. Sorry, Oracle's done 8, 9%. I said they could probably do another 8 or maybe 6. So I can do it like right off the top of my head, just start plugging in these numbers. You can also use fundamental and technical analysis to be able to project out what you think the intrinsic, value is going to be, or the target price is going to be based off the 2 methods. I could use time series regression, or I could use a Flammel-French arbitrage pricing theory model to be able to figure out what the return is going to be. I can use exponential smoothing. I can use other types of forecasting techniques to forecast where I think the stock price is going to be, by February of next year. Okay, all this. So then the next table, this is your covariance matrix. So this is basically the factorial matrix for the 25 steps. It calculates the covariance matrix, and then obviously this is the other side of the matrix. So it's a mirror. So this is automatically calculated for you. Okay? And you have 3 optimization procedures you got to do. And I'll walk you through those later. But I'm just taking you through the spreadsheet. And then from this table here, you're going to have the maximum and the minimum. So whatever stock is going to have the max, whatever stock is the minimum, you basically calculate the spread and divide it by 15. So here, that's what we do here. So this cell basically gives you the maximum in that array, the minimum, divided it by 15. There's the percentage point differential, and then you trace out, based on this differential from high to low, you're tracing out the expected return on the portfolio, which is going to trace out the efficient frontier. So now that's all you got to do is calculate the portfolio standard deviation based on the optimization procedure. Okay? You got to read this. Okay? Portfolio managers aren't reading it. One of my students who read it, he had it done in 4 days. Others are have a harder time. So this cell right here, okay, the cell right here, the first thing you're going to do is take E80, okay, and the cell J76 right there. The first one you're going to do is link that to E80. So you plug 22% in there. And then you run the second optimization procedure, and bam, it's going to kick out the weights, okay, based on that return. So then you copy basically D83 to 107, and you come over here and you paste it as a value. Okay, so your first iteration is done. Then what you do is you take J76, link it to F80, so it's now 20.7%. Run the second optimization again. Boom, it kicks out the weights. You copy D83 to 107, and you paste it over here as a value. And then you run through all 15 of the iterations, 15 of the optimizations. And then you go up here to row 82, right there, which basically takes the mean return divided by the standard deviation and gives you a return to risk ratio. Okay? And you pick a portfolio that has the highest return to risk ratio, and that's your optimal mean variant portfolio. So this percentage right here, you go back to your spreadsheet, you go back to the target portfolio, and you start messing with these, basically to replicate the weights of that mean variant portfolio, the one that gives you the highest return to risk ratio. And then what you do, since you've already put in the data for all these, it backtests your active portfolio based on the active portfolio weights. Does everybody follow me so far? So you use this spreadsheet to calculate the passive portfolio, backtest it, and then you use the spreadsheet, you save it down as active, you manipulate these to replicate the weights, and now you have the backtest for your active portfolio strategy. Now we're getting some efficiencies here, in our model. Yeah.
How are the back tests allocated in the current allocation?
What do you mean?
Like you said, the back tests are accounted for in the current portfolio allocation, is that what you said?
I don't know what that means.
Okay, maybe I just heard it wrong. Okay.
Okay.
So I didn't know that either.
So you populate this one as your passive, you backtest your passive portfolio, boom, done. Then you go run the optimization procedure in the Excel, you run all 15 of the optimizations, you look at the ratio, which portfolio iteration provides the highest return to risk ratio. That's the allocation that then you come back over here after you've saved it down. You start playing with this to get the weights to match the other spreadsheet. Does that make sense? So these weights right here have to match these weights right here. Okay? Does everybody understand? So now you're using that backtest spreadsheet to backtest your active portfolio optimization results. Okay, got it. Then if you do everything right, you run the minimum variance optimization, you run the 15 optimizations, so that's the second optimization, macro. And then the third, it traces out and calculates the capital allocation line, which is right here. And if you've done it right, your efficient frontier looks like this. And that portfolio that you just back tested is that one right there. It's the one that is tangent to the capital allocation line. So your efficient frontier should, look kind of like this. Okay, this one's okay. It's not that great, but it's pretty close. So that's the results. And then here's the right next to it is the solver for the first optimization that calculates these. And then you got the second optimization procedure that calculates all of these. And then you have the third solver procedure that calculates the capital allocation line. And again, if you do it all right, you do it the right way, it looks like something like that. So I'll be walking around, making sure that you guys are doing it correct. Okay. Here, this is the covariance matrix, right there. I'll show you where you get the, how you do the instructions are right off to the side here. Oops. Right down here. So this walks you through how to do the correlation covariance matrix, how to do the correlation matrix. And then the next is, here's your return data set. Right here. For all of your companies going back in time. So this is the data block. This is the return data set. Okay. Is everybody following, or are you just out to lunch? Don't even know what you're talking about. You need a data set. Okay. And I'll show you how to calculate this. What you want to do is you want to make sure that this data set is complete, that there's no gaps or holes in it. So what we've done is we've manufactured, I believe, about 1,007 returns. What we did was we calculated the year-over-year change on a daily basis in the stock price to get 1,000 return data points. Is that a large sample? Yeah, it's really large. So what would you assume? Would you assume that the distributions are relatively normal if you're using 1,000 normalized data sets? Yeah, they should be, right?
Yeah.
Theoretically. It's pretty aggressive, in doing it this way, but I think it was kind of interesting. So here's an example. This tells you right here the S1B NASDAQ. You're going to go to NASDAQ, and I'll show you in a minute. I just want to walk you through all the worksheets. NASDAQ will provide you with 5 years of daily data for the stock price. And you can export it into Excel and then copy and paste it over. And I've already got the formulas already set up to do the return calculations. So here's the example. You go up to NASDAQ. I'll walk you through that later on. And then boom, you export the Excel. And then here's basically the data set for, I don't know, I think this might be Apple or something. And then here's Apple. So we exported Apple, we copied and pasted the data over here, boom, and then it calculates the 365-day moving average. Okay, so I'm getting annualized returns year over year on a daily basis. It's pretty aggressive. Okay, but here we calculate how to calculate the descriptive statistics right here. So the mean here should match this one there, which it doesn't. And then or actually it does. The mean matches that, and then the median matches that one, and the standard deviation matches that one. So you know that the data set here that the descriptive statistics are being run off of are consistent with this one, so it's a validation verification, because you want to make sure that you know you're using the right numbers. Now, is this this is a histogram that I did for Apple. Is that relatively normal? Yeah, it's relatively normal. It's not perfectly normal, but it's kind of skewed, you know, but it's still relatively normal. If you look at IBM, its distribution, it's skewed, but it's kind of normal. Microsoft, that's a pretty good normal, because I'm testing for normality because we're doing mean variance analysis. So you want to test for normality in the data. I could have gone back and filtered it, you know, logged the returns, taken 2 standard deviations, gotten rid of the outliers, and then recalculated the means and the standard deviations to clean it up a little bit, get rid of the volatility. But you know, I'm just going to let it go. There's Oracle, pretty good. There's Salesforce. There's SAP. So you know, I'll work with you guys and make sure that all of this works. So if all of these are correct, you know, and you have all of these returns done, then this totally links back to this data set right here. And then from this data set, you can calculate the correlation matrix and the covariance matrix. And the covariance matrix then plugs right into and is linked to this table up here. Okay, so now we got the return forecasts, we got the covariance matrix, we got the expected returns arrays, and now we have to run the first optimization to get the minimum variance portfolio, then the 15 optimization for the second optimization 15 times, and then we run the last optimization to get the capital allocation line, identify the portfolio that gives you the highest return to risk ratio, go back to the back test, Excel spreadsheet, replicate the weights, and back test your active portfolio. Okay. Now you basically have everything you need to do the active and passive report. You're going to do a memo that basically talks, you know, about the expected return and the allocation. It's going to give you the 1, 3, 5 back tests, maybe a forward test. Gives you the sector allocations and the individual stock allocations so the investor can see exactly what your portfolio was, and then how much money you're going to invest and how much money you're going to make on the portfolio that you just constructed. So you have the memo, then you have the reports, and then you got the PowerPoint presentation. So you got one passive report, you got one active report, and then the last report is a culmination of everything up into the your final stock portfolio. Okay.
So is the first deliverable that's due next week, does that encompass this?
You just do the passive one, but we're not even there yet.
Oh, okay, got it.
So because you're not gonna even do it.
Yeah.
You ain't doing it, you ain't handing it in until everybody else has done it, you know. So then like next week I'm gonna come around and I'm gonna say, okay, what's your portfolio style? What's your sector allocations? What are the 25 stocks that you've been researching over the last 2-3 weeks? Have you put together the portfolio and back tested it? If you haven't, I'm gonna have to show you how to do it, and you guys better get together and do it. Okay? You can procrastinate all you want, but you gotta start doing, okay? All right? So I'm not collecting the deliverable until everybody starts on it. So you gotta finish the passive portfolio first. Okay, show it to me. And then once you get all that stuff and I check it out, it's like, okay, now do the memo and do the report and the PowerPoint and show me a draft of it and show me what it looks like. Okay, and then once it's there, then you guys are gonna be getting up and you're gonna do your presentation. You're gonna present your first product. Okay? Okay. Then did I already go over all these? Did I go over all these worksheets?
Yeah.
Okay. So do I need to go through them again?
No.
Does everybody know what they need to do?
Yeah.
Okay. So what we can do is, like, tonight, I'll do some more theory stuff, market stuff, and then next week we'll do a lab. Okay, I want to take a look at your pre-tests. I'll work on some of the pre-tests tonight. I want to look at a draft of the memo. I want to look at your static portfolio, your sector allocations, the pricing, see if you're doing it right. So it's, now it's kind of time to start showing you some product. Okay? Did we go over the statistical pretest except for the last piece of it?
Not part two.
Yeah, so we'll go over part 2 really quick. Okay, so let's go to chapter 13. And I went over the memos too, so can you show me the portfolio? I'm checking the pre-test. It's the first one. We have the first part of the pre-test. You gotta put more definition. Now, did I write the on the pre-test on page page 8? Did I go over the regression equation? Did I write that on the board? Did I?
Yeah.
Y hat plus alpha plus beta 1 hat x1 plus, did I do that?
Yeah.
And then did I talk about multi-collinearity, that was software? Okay. Okay, so I don't need to do that. So let's do this last piece here. Unorthodox monetary policy. So they don't talk about this stuff in the book. But how can you invest in anything if you don't understand macroeconomic policy? Okay. How do you do it? I mean, if you're going to be a portfolio manager, you got to understand what the Fed's doing. You got to understand what central banks are doing on a global basis. So we got to get, put it in a little historical context of what happened because the financial crisis has never occurred before in history of modern economic or monetary policy. And we've been around for, I don't know, a couple hundred years or a little more than a couple hundred years. We've had some pretty severe recessions and financial crises in the late 1800s. And obviously we had the Great Depression in the 20s, but then we went into World War II. And then we came out of World War II. We had intermittent recessions since World War II. But it wasn't really the 80s recession, there was a couple there, that was pretty severe. And then the 90s, early 90s, 91 to 93 was the most severe real estate recession. But the recessions were nothing compared to the financial crisis of 08, 09. It was twice as deep and twice as long, and it was a financial, it was basically a financial crisis, okay? Led by excesses in the capital markets and corruption based on Wall Street and in Washington that basically perpetuated it. When I'm talking to my clients, they're talking about the 300-pound gorilla that's sitting in the room. That's how they say it. You know, they're looking at a Federal Reserve, you know, that's willing to print trillions of dollars, you know, to buy up government bonds, you know, to throw those bonds on their balance sheet, explode their balance sheet, and basically run a Federal Reserve, you know, monetary policy that's never been conducted like this before. So it's not orthodox monetary policy, it's unorthodox monetary policy is what we are existing in today, okay? And if the financial crisis occurred once, can the financial crisis occur again? Yes. So you as basically finance managers have to understand that how are you going to manage these portfolios from an investment and a risk management standpoint if there's a probability of another financial crisis that's going to occur. Do you just assume away that it's not going to happen, you blow off your fiduciary responsibility, and you become totally negligent about the whole thing and say, well, I didn't know it was going to occur, but sorry, I didn't mean to lose like billions of dollars of your pensioners' money. Sorry. That usually doesn't cut it, in my view. So let's look at, you know, the Federal Reserve today. And you could even Google some of this stuff. You know, what is the size of the Federal Reserve's balance sheet today? You can Google it. Where's the size of the balance sheet right now? How big are the reserves on the balance sheet?
There's probably a trade deficit.
Well, the trade deficit has nothing to do with the Fed's balance sheet.
Their liabilities have quadrupled to 3.19 trillion.
Yeah, like 3 trillion. What's the assets and the reserves? You know, you can Google it, look it up. Okay? It has nothing to do with the trade stuff.
What was the question?
The question is, how big is the Fed's balance sheet? The liabilities are 3.1 trillion. What are the total amount of reserves that are currently being held at the Federal Reserve on behalf of the banks? So where are we now? 2020? So you said 3.1 trillion? Is that right? Is that right?
Yeah.
Okay. And between 2008 and let's say 2010, how big were the liabilities?
Beforehand, they were 870 billion.
Yeah, before it, they were what?
870 billion.
Okay, 870 billion, and actually even before that, they were 250 billion.
And it was 7% of GDP at that time. And then now it's 18 billion.
Yeah. So if you look at the chart, you know, of reserves, going back to like 1945, it goes like this. And then all of a sudden the financial crisis hit, and it goes like this. Right? And now it's kind of going like this.
And
So in here it peaked at about 5.3. So basically the Fed printed out of thin air 5.3 or $5 trillion. So it took their balance sheet from 250 billion to 870 billion to 5.3 trillion, And now they've been trying to sell it off and bring down the balance sheet to give them some bullets, you know, to be able to conduct monetary policy if we go into another financial crisis or another recession. So this is totally unorthodox, never been done before. The Federal Reserve has done it, and all of the global central banks have done it too. So now all the central and global banks, if you add up all of their liabilities from, you know, money printing, it probably is around 40 or 50 trillion dollars on a global basis from all of the major central banks. Never been done before in history. Nobody knows what the implications and the ramifications are going to be of this. You guys are finance major. Is this interesting? Yeah, because you're going to be living through. I'm freaking 60 almost. You guys are 20. So you're going to live like 30, 40 years. You know, maybe you'll live until like you're 120. So you're going to see a lot of stuff. Okay, I've seen some stuff, but you guys are going to see a lot of stuff. Okay. And you're going to have to learn how to manage through this stuff if you want to be in finance.
So when the Federal Reserve prints more money like that, doesn't it drive up inflation like that?
Theoretically, it should have, but it didn't have an impact on inflation, because basically productivity gains from the tech sector had pushed down wages, and the recession that occurred, the Great Recession, basically dislocated the economy and basically sent, millions of people into poverty. So they didn't have any wages, or wage growth to really create wage inflation. Okay? And the theory was that if they did print this, we would get hyperinflation, but it didn't happen. And actually it did happen, because they printed all this money, they bought all these bonds, they injected all the liquidity in the system, and then since we're in an open, global financial system, all of that liquidity at very low interest rates was injected into the global markets and went into undeveloped and underdeveloped capital markets. And the worst victim of all of this was basically Argentina, because there was massive capital flows into Argentina that created hyperinflation and political instability. Same thing happened in Brazil, and the worst case was in the Middle East, okay, where you had the Arab Spring. The Arab Spring was basically started by an apple cart seller who basically couldn't sell enough apples anymore because apples were costing like $1,000 a piece due to hyperinflation, so nobody basically bought their apples, and he self-emulated himself and created the revolution in Egypt in the Middle East. Okay, so huge spillover effects, not here, but definitely in underdeveloped and newly developed countries on a global basis. Okay. Nobody talks about that linkage. It's totally taboo, but it was a direct link due to what happened here in the United States to try to mitigate the damage, because we were going into a depression. Okay, the banks were insolvent. We had to bail out the banking system. So we printed trillions of dollars and bought all the crappy securities off the bank balance sheets, threw them onto the Fed's balance sheet, and then the Fed basically liquidated treasury securities and gave them to the banking institutions. They basically printed money and bought all the credit default swaps and all the defective products, threw it on the Federal Reserve's banking system, on the balance sheet. And then they printed all the money and bought all the mortgage-backed securities to clean up the housing market, to get the circular flow working again within the system. So the Federal Reserve not only was the lender of last resort, but it was the market maker of last resort, making marketed illiquid financial instruments such as commercial paper, which is a hugely liquid market. They were making market in the mortgage-backed securities market. They were buying CDOs and other, messed up, defective products, basically bailing out the banking system, recapitalizing it, but basically taking private liabilities and putting it on the public institutional balance sheet and creating a public liabilities. And at the same time, the Treasury was basically, by signing of Congress through the Jobs Act under Obama, approved by Congress, they issued, basically approved a $900 billion, almost $1 trillion Jobs Act. So you got $5 trillion here, you got $1 trillion there, and then you got massive budget deficits that have been running over the last 10 years, doubling the amount of debt outstanding from basically 12 trillion to over 22 trillion and moving up on $1 trillion a year in fiscal debt going forward. The reason why the inflation hasn't occurred is because there's so much debt out there by corporations, individuals, and the federal government that it's sucking in all the investable capital to service the interest rates, and a lot of that capital that should be going into productive investments is going into servicing the debt. So you're not getting the hyperinflation that otherwise would have occurred based on macroeconomic theory. Okay, so it's a perverse situation. Okay? Macroeconomic theory is not working as we know it. Finance theory is not working as we know it because we've never been here before. But yet we still teach finance classes as though it's the same as it was over the last 30 years. It's not, it's different. Okay? And we as managers have to realize that. So we know what the balance sheet was. How much money by banks are being held on reserve at the Federal Reserve? It's basically close to the same. Okay? So reserves and the assets and the liabilities are basically the same. So it's an identity. What was it prior to 2007? Well, prior to 2007, it was around 870 billion. And then if you go back 30, 40 years, it basically for decades, it was 250 billion. So 250 billion for decades, then to 870, and then the 5.3 trillion, and then now down to 3.1 trillion. Okay, so that is kind of messed up. Okay, it's not totally unorthodox. Has the Fed hit its gross domestic product, employment, and inflation targets? If we fell into a recession, would the Fed use negative interest rate policy? What would be the impact on the economy, asset prices, savers, investors, and businesses? This is a big debate right now. So what I did was I tried to figure this out. And bam, it came to me one night, I woke up, and then I said, okay, this is how I gotta look at this thing. So the theory that answers this is the quantity theory of money, which was invented by Irving Fisher. And this is also the theory of transactions, okay, the transaction theory. So the quantity theory of money, okay, is GDP, gross domestic product, real, times the inflation rate is equal to, or is the identity to, the velocity of money times the money supply growth rate. Okay? So the Fed is targeting GDP at 3%. That's their target. So they conduct monetary policy to try to push the economy to grow at 3%. Okay? Their inflation rate target is 2%. Okay? And then the velocity of money, they assume they can't manage the velocity of money. The velocity of money is the number of times currency, M1, or near currency, M2, circulates through the economy on an annual basis. And it's usually around 9 times. Okay? The historical average on M1 is like 9 times. Okay? And then the money supply growth rate. Okay? I'll get to that in a minute. During the financial crisis, the Fed was growing the money supply at 30 to 40%. They were freaking printing money as fast as they could. Okay? To try to get this if you hold everything else constant, if I'm growing the money supply at a very rapid rate, I can push GDP up significantly because I'm lowering interest rates to 0. So people are going to consume and buy. If they can, borrow at really low rates, they're going to borrow, consume, and businesses are going to invest. That's the assumption. Yes.
So the dollar didn't depreciate that much during.
No, because there was massive capital flight coming into the United States because all the other countries on the dollar basis were inflating. And there's political instability. And the U.S. is considered a central bank. And then imagine this is one of the reasons why the inflation rate didn't go up either, because the massive capital flight into the United States caused the dollar to appreciate significantly. Well, the dollar has appreciated significantly. What's happened to foreign currency? It's depreciated significantly. So does that make your imports more or less expensive? If the value of your currency goes up and their currency goes down, is it cheaper or cheap? Is it cheaper or more expensive to buy their goods? It's cheaper. So these goods are coming in cheaper. What does that do to inflation? Do we import or export more? We import more. So imagine we're sucking in all these cheap imports. What does that do to inflation in the United States? Yeah, it holds it down significantly. So that was another disinflationary effect after this time period. Okay, so the Fed was pumping 30 to 40%, growing the money supply 30 to 40% to try to get GDP up to 3% and the inflation rate to 2%. And what was happening is GDP was growing at about 1.7%, and the inflation rate was around the same too. It was like 1.7%. So growing the money supply at this rate, was the Fed hitting its target? No, it didn't hit its target. Got it. Okay. So the question is why? For years, the Fed has not hit its gross domestic product targets. What is it now? I mean, it did hit the target of 3% in like 2017, 2018. So it was like yes. They hit the inflation target on on inflation. I think it was like almost 2 at the same time. So the answer was yes. Okay. But here, for years and years and years, 2010, 11, 12, 13, 14, 15, 16, the Fed was not hitting its target, and it was growing the money supply. Okay. But then what the Fed did is after 2008, 2009, they started slowing the money supply, and it dropped to around 10% to 8%. So the Fed was lowering the growth rate. So if you lower the money supply, holding everything constant, you're not going to hit your GDP targets. So that was one of the problems there, Jim. The other was that the Fed was pumping all this money into the system. It wasn't hitting its inflation or GDP targets. So and this was my thing. It's like, why? They're pumping all this money into the system. They've blown up their balance sheet. Injected all this liquidity. Why didn't it have an effect on inflation and GDP? It's because the velocity of money collapsed. The velocity of money, if you look at it, going back to 1945, it goes like this. It's counter-cyclical, kind of peaked, in the late 80s, and then it slowly went like this, and then it went basically the velocity of money, which has recovered a little bit, is well below its 1964 level. So it broke through the supply. So the question is, why is the velocity of money collapsed? It's because there's so much debt in the system that's sucking all of the liquidity out of the system to service the debt. Okay? And this is consistent across the globe. The velocity of money is collapsed. Okay? So my theory was, okay, if the Fed's not hitting their targets, right, and they're not hitting GDP and inflation targets, then what they need to do is probably pump more money into the system, which they've been doing through the repo market, or they need to figure out how to increase the velocity of money. Go ahead.
I was just wondering if money supply goes down and people aren't printing more money and velocity goes down as well because people are using credit.
You're not gonna hit your GDP or your inflation
But what if it
targets.
doesn't matter? Like, what if we move towards like a society that relies more on Bitcoin and like,
Yeah, but that's not the case as of this point, but it could.
but what if that like render
The
the
theory,
equation?
the theory somewhat muted.
Yeah.
Yeah, so there could be underlying technological effects that are causing velocity to collapse too. But from my research, what I found out is velocity is pro-cyclical and highly correlated to the employment rate and to labor participation rates. So basically, and here's the major takeaway here, is that basically monetary policy is ineffective. Because monetary policy just basically manages the supply of money to hit their targets, the economic targets. But the velocity of money is not monetary policy, it's labor policy. It's labor. So the Federal Reserve controls monetary policy, but it's Congress and the President that control labor policy. And basically labor policy in the United States does not work. They use monetary policy to basically manage the economy. They do not promote labor union participation, massive money going into job retraining, free education for everybody to upgrade their skill sets and pump out, a highly skilled labor force. That ain't gonna happen, okay? Because it's basically an ideological war between capital and labor that's been going on for 500 to 700 years. We are a capitalistic representative democracy, and the system is basically set up towards capitalism, not communism or socialism. So there's no labor policy. So the Fed's tools to stimulate the economy to hit its targets in GDP and inflation is effective only up to a certain point, and then it's ineffective. So the Fed basically does not have the tools to basically conduct monetary policy to get the economy to reach its long-term potential or its inflation targets. Okay? That's why it's called unorthodox monetary policy. Then the question is, has the Fed hit its GDP target? No, but it did, and it's not now. Because GDP just came out, what is it, like 2 point?
Like 2.1.
Yeah, so it's like 2.1. So they did, but now they didn't. So theoretically, what should the Fed be doing? If they're not hitting their target, you're holding inflation and velocity constant, what should the Fed be doing to hit its target?
Increase the money supply.
Got it. Increase the money supply and lower interest rates. Okay. Got it. Have they hit their employment or unemployment targets? Yes. Yep, because the unemployment rate is what?
3.7.
Yeah, it's like 3.7. The natural rate of unemployment, or the NAIRU, the non-accelerated inflation rate of unemployment, is probably around 4%, and we're at 3.5%. So we're below the Fed's target. So they've exceeded the target on inflation. On unemployment. Have they hit their inflation targets? No. And actually, inflation turned negative recently, and is really low. So they're not hitting. If they're not hitting their inflation targets, follow me. If you hold GDP constant and you hold velocity constant, and you're trying to get to 2%, what should the Fed do? Increase the money supply. Exactly. Okay. And now they're only doing quantitative easing through the repo market. They're saying we're not doing quantitative easing, we are injecting liquidity into the system through the repo market. So they do have quantitative easing going on, but it's not aggressive enough to move the needle on inflation.
If Okay, so that graph that you drew under velocity is the velocity of the
Yeah,
ball,
you can
right?
go up to Fred, you can type it in Fred, and you can go to the Federal Reserve Bank of St. Louis. Under Fred, and you can type in velocity of money, and it'll bring up a chart going back to like 1945.
Okay, but I have a question. So obviously GDP is as high as it's been, but velocity is not as high as it's been.
Now, velocity has collapsed to around 6 times.
But I'm just wondering, why is GDP still increasing even though velocity has gone down?
Actually, velocity has started to stabilize. The problem is that velocity was going down faster than they were growing the money supply, so it had no effect on inflation or GDP. So you can pump out as much money as you want, but if velocity is falling faster than the rate at which you're increasing the money supply, you're going to have no effect on GDP. or
So is
inflation.
velocity not really considered as like a benchmark? Like there's no benchmark here, it's just,
No, it's, it's the number of times. It's like, if you look at it, it was 9x at the peak,
yeah.
1988, but velocity has been secularly falling, and then it collapsed, okay, after the financial crisis. Because there was so much debt in the system that it was sucking out all the liquidity and all the cash to service the debt. So to get velocity up, what you really need, the velocity is tied to employment, and income, and wages. So you need labor policy to get velocity to go up, not monetary policy. The Fed does not control the velocity of money. From my research, it's labor that drives velocity up. People make more money, they spend more money circulates through the system. If people are making less money and they have more debt, then all the money that they would be using to spend and consume is being sucked into servicing the debt. So velocity is collapsed.
Do you think that velocity will continue to
Remain low?
Because
Will it remain low? I say yes.
because of the recent tax break, like because it's going into savings as opposed to other.
Most of the money that people are getting, and you particularly as students, a lot of your income is going to service your student loans.
Right.
Okay, so you can't, and you're using your credit cards to basically maintain your standards of living. So the majority of the money that you make is servicing your student loans and your personal credit. You're not consuming it, so it's not having an effect on GDP.
Do you think that also could be due to the fact that there are like tax breaks and rich people are more willing to save, so the money that's being allocated has less of a
Well, yeah, the people, those people who got the tax breaks are putting money into bonds and stocks. They're not putting it into investments,
Right.
new businesses, plant equipment. That would create a multiplier effect that would have a direct effect on GDP. So it's a total misallocation of resources is what it is. And the monetary policy is not having an effect on GDP and inflation because velocity is broken and the money is misallocated into non-producing assets. Okay, we're not seeing investment in plant equipment, okay, in bridges, and roads, tangible stuff that create perpetual benefits, over multiple generations and multiple lives. So I don't want to do too much on this, but that's kind of the point. Okay.
What's the difference between the liabilities and the assets on the Fed's balance sheet? When the banks basically buy the bonds from the banks, that money is put on reserve, so it's a liability. So basically, the bonds are the assets, the reserves are the liabilities. And your assets and liabilities have to match. Yeah.
Right? So the reserves and the Fed's balance sheet are basically the same. You can get into the nuance, but the real point is it went from 250 billion to 870 to 5.3 down to 3.1, and it's still huge. When we go into another financial crisis, they'll print probably another $3 or $5 trillion, and we'll be looking at a Fed balance sheet of probably 8 to 10 trillion. And again, we've never been there before.
I'm a little confused how it's like 5.3 trillion because I'm on the Federal Reserve's website and it said that like in 2008 it went up to 2 trillion. So I wasn't sure what the difference was coming in.
In 2008, well, it peaked out at like 5.3.
Oh, the graph doesn't show that it even
like surpass like 2.4
No, it's more than that. It's more than that. It's total reserves.
I'm looking at total assets of the Federal Reserve.
Yeah, it depends on what assets you look at. I'm just saying theoretically, the assets and liabilities have to match. It was 250 billion, it went to 870, and then it went up to like 5.3. And then it's now down to like 3.1, 4.1, as they've been liquidating their bond portfolio. But now they're implementing the repo, quantitative easing again, so they're now building their liabilities and their balance sheet back up again.
So on this,
So they're printing money again to inject liquidity into the system.
on the pretest, you want us to put the like amounts of liabilities or the amounts of the?
It doesn't matter, they're the same. You could just say reserves. Doesn't matter, it's the same thing.
Well, I'm just looking at it, it doesn't seem like it's matching up, so I wasn't sure why it's different.
Just use mine.
Okay.
Because I don't know the source that you're looking at, I don't know what the line items that you're actually looking at.
It's just the Federal Reserve.
You know, use these. I'm right. So 250, 870, 5.3, you can use 3.1 or 4.1, try it. Okay. All right. And then the next one is discount rate and expected return, cost of capital, yield curve dynamics, using the Fisher equation. What variables drive the risk-free rate or nominal interest rates up? So you tell me. Using the Fisher equation to determine nominal interest rates, what are the two variables, two factors in the Fisher equation that drive nominal interest rates up? In doubt. What is it? Nominal interest rates, what's it? Expected means nothing to me.
Real
The real what?
interest rate?
Yeah, the real rate. Got it. Yeah, plus inflation, expected inflation.
Oh, yeah.
Okay. So the real rate has been on a secular decline, but it doesn't move every single day in the marketplace, it's unobservable. So basically it is a constant. So what drives nominal interest rates up and down?
Expected inflation.
Got it. So if inflation expectations go up, nominal interest rates go. Got it. And if inflation expectations go down, nominal interest rates go. Got it. So the 10-year treasury yield today dropped to what? What? Yeah, it's like 1.6 something, right? So if it's falling, if the nominal interest rate is falling and real rates are constant, then what's causing the 10-year treasury yield to fall? Lower inflation expectations. So what happens when the economy is growing rapidly, what happens to prices and inflation? It goes up. When the economy starts to slow and decline and contract, what happens to inflation? It goes down. So if the 10-year treasury yield dropped, what does it tell you about inflation future inflation expectations? The market is expecting the expected inflation to go down. What are they expecting then? Slow economic growth, exactly, in the future. The bond market's huge, and it's mostly correct most of the time because it's so big. So we could be falling into a slow growth period, or we could actually, if this goes down significantly, and this goes down significantly, then we could be going into a recession. All right. Nominal interest rates on U.S. Treasury securities, private maturity up and down. What shifts the yield curve up and down? What flattens it and what inverts it? Let's do the yield curve. So there's the yield curve. This is my 3 month, 6 month, 9 month, 1 year, 2 year, 5 year, 7 year, 10 year, 20 year, 30 year maturity bond on U.S. Treasury securities. And then there is an interest rate associated with each maturity.
Is this an upward sloping yield curve? Is it a normal curve?
Yes.
Yes, it's upward sloping. And it's normal. When the yield curve is normal, there is a very low probability that we will be going into a recession because the market is expecting higher inflation expectations due to economic growth. You know, okay? This is the normal curve. This is the yield to maturity or the interest rate for each of the individual bonds by maturity. Yes, Sharon.
If the yield curve inverts based
Yeah,
on.
I'll do that in a second.
Okay.
So give me a second. I need to teach this first. Okay. So if the yield curve shifts up, what did inflation expectations do? Come on, you guys. If the yield curve shifts up, what did inflation expectations do? They go up, exactly. So if the market expects inflation expectations to be higher, then interest rates will go up, and the yield curve will shift up. Got it. And what if the yield curve shifts down? What does that tell you about inflation expectations? Got it. Okay. Excellent. And then you got to remember too that the Federal Reserve controls short-term interest rates. Okay. So they conduct monetary policy in here, but also the yield curve has medium-term bonds and long-term bonds. So basically, the bond market is segmented by short-term, medium, and long-term, and the Federal Reserve buys and sells bonds on the short end of the yield curve to conduct monetary policy. Okay. So let's get going into this. Show the equation and graphical representation of a normal upward sloping curve. Show me a flat yield curve. Another color. I have to use blue. Here's a flat curve. So if the yield curve starts to flatten, what does that tell you about inflation expectations in the short run? If the yield curve is flattening and short-term interest rates are going up, what does that tell you about inflation expectations in the short run?
Zero.
They're going up. Got it. They're going up. And then what happens if the yield curve inverts? What does that tell you about inflation expectation in the short run? Higher. What does that tell you about inflation expectation in the long run? Lower. What does that tell you about future economic growth? Slowing down and potentially in a recession. The yield curve inverted about a year ago. At the end of 2018, and the market lost like 1,000 points once it inverted, spooked the market. And then the Fed stepped in, started buying bonds, driving up bond prices, driving down interest rates, and tried to make the curve level again. And the curve just inverted again like 2 days ago. So what's important about this inverted curve is once the curve inverts, the stock market peaks within 12 months and you're in a recession within 24. Okay? And it's the most accurate predictor of recessions. It's persistent. There's a lot of pundits out there that are saying, oh, well, things are different right now. And the curve never inverted in Japan, and they've been in 14 recessions in the last 15 years. So that theory is debunked. I don't believe that. I think it's an extremely accurate predictor. What impact do movements and shifts in the yield curve have on asset prices? Well, I can use just a simple perpetuity model, right? Where I have the cash flow next year divided by my discount rate, and obviously interest rates are embedded in my discount rate. I can use CAPM if I want to calculate the discount rate for the cost of the equity or expected return. So I'm going to get my value. So if the yield curve, come on, test question, if the yield curve shifts up, what happens to the discount rate? It goes up. And what happens to the values of the bonds and the stocks? Go ahead.
If the yield curve shifts down, what happens to the discount rate for expected return? It goes down, and what happens to the value of the assets?
Okay.
It goes up. Got it. That's the question right there. You should be writing all this stuff down. How does the Federal Reserve influence interest rates? Well, they buy and sell bonds in the open market through open market operations. This is the tool. This is the monetary policy tool that they use, open market operations, to basically buy and sell bonds in the open market. So if the Fed is buying bonds, what happens to bond prices? Come on, you guys. They go up, and if bond prices go up, interest rates go. Okay, and if the Fed sells bonds, what happens to bond prices? The Fed sells bonds, bond prices go down, and interest rates go. Got it. So the Federal Reserve uses open market operations to buy and sell bonds to drive bond prices up and down, interest rates up and down, to either cool or stimulate the economy. Okay? Do I need to repeat that again? Okay, the Federal Reserve uses open market operations to buy and sell bonds, to drive bond prices up and down, to either cool or stimulate the economy. Okay? You got that, or you want me to do it again? One more time, or do you have it? One more time, or you got it? Okay, yeah.
You said if the Fed sells the bonds.
If they sell bonds, the supply of bonds increases, bond prices go down, and interest rates go up to cool the economy. If they think the economy is falling into a recession, they'll buy the bonds, the bond prices will go up, and interest rates will go down, and that'll stimulate the economy. Okay. All right, how does the Federal Reserve influence interest rates? Through open market operations, buying and selling bonds. What policy tool do they use to move interest rates? Open market operations. What is the objective of buying and selling bonds? Well, if they buy bonds, bond prices go up, interest rates go down to stimulate the economy. If they sell bonds, bond prices go down, interest rates go up to cool the economy. Okay, got it. What is the impact on interest rates? We already talked about. Does the Fed control and influence directly short-term or long-term interest rates, or both? Now, the Federal Reserve directly controls the short-term bond market, the short end of the yield curve. They conduct open market operations on short-term Treasury securities. Okay? They have a direct effect on short-term bond prices and interest rates, a direct effect, and an indirect effect on the long-term and medium-term bond prices. Because of the Federal Reserve, and this is usually what happens every frickin' time, is the economy will start to overheat, or there'll be asset price bubbles in the bond market, the stock market, and the real estate market. And the Fed will go in and try to prick these asset price bubbles by selling off bonds to raise short-term interest rates to try to cool the economy. Now, they never have. Usually what they do is they keep interest rates too low, too long, and then they start to see these asset price bubbles. They panic because they start to see the asset price inflation, and they start to sell off the bonds. They flatten out the curve. They oversell the bonds. They invert the curve, causing short-term interest rates to be higher than long-term, and they end up engineering a recession every freaking time. Yes.
So with the Fed dropping interest rates like 3 times last year, and I think
Yeah.
Jerome Powell said he was gonna keep it pretty low,
Yeah.
and then
Yeah.
the yield curve inverting again, do you think the recession's gonna happen like within a year?
If the curve's got to invert, right, the spread between the 3-month, or the 1 year, and the 2 year, and the 30 year, that's kind of how they calculate it. The spread's got to go negative. They say by about 150 basis points.
How long does it have to stay negative?
Like maybe a couple quarters or so.
Oh, really?
Yeah.
Oh.
So it's got to be kind of a permanent inversion, and then it trickles through, and it messes up the banking system and screeches businesses to a halt. and then that creates a recession right around. So the yield curve is the number one factor, the number one predictor. Here's the example right here. I can get this. I'll show you.
Do you think interest rates are too low?
Yes. Yeah, they left them too low too long. And I'll show you. So what you want to do is you want to go to stock chart, or type in your Google, type in dynamic yield curve. Okay? Dynamic yield curve.
Okay, I have a question.
Okay, right here, where it says stockcharts.com, click on dynamic yield curve. Here's the dynamic yield curve right here. Okay. And then what you want to do is you want to click here.
This is a video.
Is that not the good here?
No, not that.
Yeah. What is this one?
Instructions.
Huh?
This looks like instructions, but not actually video.
I don't want it. Oh, is that what you did too?
No.
I don't want this. Yeah.
You go all the way up,
I go all the way up.
and then click dynamic yield curve.
Right here?
Yeah, that one.
Okay, thank you so much. They changed the website. Okay, here we go. This is and then you want to click on family. Let me walk you through it. So here's the S&P 500, and here's the yield curve. Look where the yield curve is, how flat it is as we start to approach the peak in the stock market in 2000. So the Fed is selling off the bonds, trying to cool the overheating in the asset price market, and see, look, and watch it inverts right there, and bam, we start falling. The market starts a massive sell-off. As the market starts to careen, the Federal Reserve goes, holy crap, I need to mitigate the damage that's occurring because we're going into a stock market crash, which is going to lead into a severe recession. So they're going to start buying the bonds, driving short-term interest rates down and getting the curve normal again. So look at how low the interest rates got right here. But look how low the interest rates got, the short-term rates, in the 08-09 recession. So look how steep the curve is right there. So the Fed is just buying, driving down interest rates, trying to get people to consume, borrow, businesses to borrow, to invest, to try to get the multiplier effect of the economy started again. And as you can see, now that the stock market is increasing and the economy is starting to recover, the Fed starts selling off the bonds, starts flattening the curve, and then watch, tell me when the yield curve inverts. Tell me when the yield curve inverts. Watch it. It looked like it just inverted.
Right there.
It looks like it, and then it's really going to invert like now. Got it. And the stock market peaks a year, within 12 months after that. And then within 12 months after the 24 months after the inversion, we're in a recession. So those are two examples. You can go back like 70 years, 80 years and do this, and it's just every single time. It works every time. So here we're falling off a cliff. Now watch how low the Federal Reserve drives interest rates, all the way to zero. Now if we were in Japan or in Germany, it would be down here, it would be negative. And actually what they did was they printed a ton of money, and they basically drove interest rates negative all across the curve to here. We didn't do that. If we fall into a severe recession and another financial crisis, the Fed has already said, we need you, the banking industry, to run a scenario, a stress test, under a negative interest rate scenario. Freaked everybody out. Because negative interest rate policy hasn't been proved as an effective tool to grow the economy over the long run. And Japan and Germany and other areas of the globe are still under negative interest rate policy 10, 11 years after the financial crisis. And it's destroying their banking system, and their savers are in really bad shape. Because if I'm a pensioner and I'm buying negative interest rate bonds to live off in the future, I'm gonna get less in the future than I actually paid for that bond, so my standard of living and social welfare is actually being destroyed.
So would the Fed actually consider using the negative interest rate policy?
Yes, they've actually, Jerome Powell mentioned that. Janet Yellen had the banks run stress tests on the balance sheet under a negative interest rate policy. Jamie Dimon, all the major banking CEOs said it would be a horrible idea if we went down that path. Do not go down that path. Because it's basically a black hole. It's a rabbit hole. It's never been tested. There's no economic or finance theory under a negative interest rate policy. When you read your book, there's no mention of it, and there's no examples of the effect on asset prices or debt securities or stock prices under a negative interest rate regime.
So I've heard that consumers' propensity to spend just wouldn't increase if it were
That's the
negative.
theory, but in
Because-
Japan and Germany it didn't come true.
Yeah, because it's already at a real rate of 0.
Well, under a negative interest rate policy, I'm actually getting a positive real return on cash.
Yeah,
So I'm not buying bonds, I'm going into cash. But the problem is the banks that buy a lot of those negative interest rate bonds, on their balance sheet, they gotta pay positive deposit rates, are getting negative arbitrage, and it's creating disintermediation in the banking system. So slowly, the banking system is collapsing in those markets. Because the banks cannot buy negative interest rates and then pay positive interest rates to their depositors. So now in Switzerland, they're telling the very large, depositors that now you have to pay us to hold cash at our bank. So now negative interest rates are now starting to affect a certain class of investors. So where's the stock market today? Where's the stock market today? Where's the S&P 500? Look at it. It's off the freaking chart. It's only gone straight up since then. Because the Fed's got a balance sheet that big and printed a bunch of money and injected a ton of liquidity into the banking system. Nobody's putting into productive assets. They're buying paper assets. They're buying stocks and bonds and real estate. So let's look at this and then we'll go on to the next question. But just watch, when we get to here, did you notice that interest rates went to 0? And then they went to 0 along the curve. And then the long rates started to come down because they started buying longer. Securities tried to stimulate the economy because we were in a liquidity trap. Okay? And Lawrence Summers from Harvard mentioned, negative interest rate policy, low interest rate policy, it's not having an effect because nobody wants to invest, nobody wants to consume because they're scared of another recession, another financial crisis. So you're not going to be spending any money on the G.I. Joe with the Kung Fu grip, when you know that you're going to be out of a job. Okay, here we go. So now we're going to 0. And then watch, the Fed will start buying the long end of the curve to bring medium and long-term interest rates down to spur plant and equipment borrowing from corporations. So the Fed is, let's see how high interest rates go at the peak. The economy started to recover, stock market recovered. Now you broke through the resistance right here in the prior two cycles. So the Fed should have been raising interest rates, but they didn't. They kept interest rates really low and then brought down the long end of the curve. And there was massive inflows, capital inflows into the United States, into long-term bonds, because foreign bonds were giving extremely low and negative interest rates and the US was still giving positive. So the curve started to flatten. So now you broke through the resistance. Interest rates are still low. And let's see how low they stay through the next. Still low. Still low. Now you're in uncharted territory. Then I believe the Fed started to pull QE there and the market's convulsed. There wasn't enough liquidity to clear the market. So the stock market lost like 1,000 points. Then the Fed came in, started QE again, pegging long-term, short-term interest rates, still at 0, even though the stock market is at an all-time high. The long end of the curve is at historic lows, and the stock market continues to go up because there's so much liquidity that people are basically taking money and investing it in stocks. And look at how low, okay, the short-term rate, look, it's starting to flatten. Short-term interest rates are coming up. It looks like the Fed tried to slow the asset price bubble. Look, it looks like it's going to invert. Looks like it's going to invert. I just inverted. Boom, stock market corrected. And then all of a sudden the Fed stepped in, started buying the bonds. And look at this. This is telling you that they're expecting a recession in 2 years, 21, 22. When it inverted like that, it went like that. It's basically the curve is telling you that the market is expecting a recession in 2 years. That's basically 2021 and 22. Okay. So the proof is in the pudding. So here, what are your overall observations of the relationship or correlation between the yield curve and the S&P 500 since 1998? Positively correlated, right? The yield curve has an influence on the stock market.
So when you say like, because basically the Fed was able to like counter the recession for how many years, like 10, 11 years now, because they kept interest rates so low.
Yeah.
Are you saying that they can't do that again because liquidity is so high that it would cause inflation?
No, I mean, there is no inflation. Really.
But if they drop, like if they were trying to avoid this recession that's happening,
Oh, they would drop interest rates again.
Right, but wouldn't that cause inflation?
We haven't really seen hyperinflation.
Not hyperinflation, but
No, but what's inflation? I mean, I mean, they're targeting 2. They can put up with 3. Will they put up with 5? Probably not.
okay.
And they thought the economy was overheating, the asset prices were overheating. That's why they inverted the curve. And you saw it invert already. So, and it already inverted again over the last 4 days. Okay. So my only point is that the yield curve is a predictor of recessions. And all debt and equity securities that are priced and issued in the marketplace are priced off the yield curve. So if I'm going to issue a 3-month bond or 3-year bond or 30-year bond, I'm going to use the Treasury yield curve as the base rate and then start tacking on some risk premiums. So basically all debt and equity securities and real estate and derivatives are priced off the yield curve. That's why it's so important to understand it.
You said that this goes back like 70, 80 years.
Yeah, this went back to 2000, but the
Yeah, like
same
pattern.
predictive capabilities of the yield curve. I could go back to 1970s, I could go back post-World War II, I could even go back and find proxy yield curves, 150 years, and it's persistent.
Okay, so it's just like the data kind of runs out around like 80 years ago, or is it?
Well, the 10-year treasury, the treasury yield curve, government securities were basically issued in the trillions of dollars or hundreds of billions of dollars to finance the war.
Okay.
So it created basically the bond market.
So that's why it goes back until then?
Yeah, so you usually use post-World War II. And then from the 70s, it's been persistent. You could even go, some people have gone back 150 years. It's the same predictive capabilities. Okay, all right.
Wait, I have one last question, sorry.
Yeah.
If Germany and Japan just randomly decided to raise their interest rates to 0 and make that the floor, would that cause deflation
In Germany, it would probably cause a recession.
in Germany?
Yeah. Because the cost of capital is so low that they're trying to stimulate the economy through extremely low interest rates. If you start to raise interest rates in an economy that's already fragile and is already, big borderline stagnation. I mean, Germany has already tried to raise interest rates and sent its economy into a recession over the last 2 years. So any slight movement in the yield curve of short-term interest rates has caused Germany to go into a recession.
So there's no way to pull out the,
Well, that's the scary part, Because we might be in a monetary policy regime environment where there's nothing you could really do to stimulate the economy, and you basically have to continue to print money forever. And allow the fiscal side to continue to rack up debt and structural deficits, to try to pump prime the system using Keynesian, demand side, policy. So we've never been here before, okay?
So when companies go like in Germany or Japan to take out loans from banks, like how
At
is
very low interest rates,
oh, it's just very
it's like
low.
really low interest rates.
Does
And in
this
some
work?
cases, they're thinking about creating monetary policy that will provide banks with liquidity to basically pay borrowers to take out loans. So instead of paying an interest rate, they will give you money to borrow from them.
You said
That turns finance on its head.
they're thinking about it just now, but they haven't done it.
Yeah, they're thinking about it. Yeah, that turns finance theory on its head. Okay, so over the last 10 years, finance theory has been turned on its head. Okay? It's brutal. And the book's not going to talk about it. Okay? They're not going to even talk about it.
And for the banks that are giving out very low interest rates, is that still a spread based off their company's treasury? Or
Well,
do
if
they
they
just
can-
send it in?
If they can borrow from the Fed at really low, at zero, and lend it out to you as a student loan person, maybe they borrow at 4% or 2%, and they lend to you, let's say they borrow at 3, and they lend to you at 8, their interest margin and their interest spread is 500 basis points. Right? Because you look at credit cards right now, right? They're like 16%, 13%. They're borrowing at 3 and charging you 13. They're making 1,000 basis points on you, on the spread. So, the banking industry is a monopoly. Okay? It has the Federal Reserve, which protects them and gives it a comparative advantage over other industries within the economy.
No, that's okay.
Okay. So what are the overall observations of the relationship between the yield curve and the S&P 500? It's positive, right? Did the yield curve lead or lag the peak in the stock market? Well, it led the stock market peak. If it did, by how many months? 12. Did the curve flatten or invert? Yes, it did. It flattened and then it inverted. Prior to the peak, yes, it flattened and inverted prior to the peak. On the short end or the long end of the curve? The short end of the curve. Can you use the yield curve to predict stock market peaks in the recession? Yes. By how many months? 12 and 24. Okay, there's your answer right there. Okay, any questions? I'll probably only get through half this. Then I'm gonna have to. What time is it? So I gotta get it before the morning. So let's go through this. So what is important? Why is it important to track the stock market, the bond market, the oil market, the gold market, and the value of the U.S. dollar relative to foreign currencies? Why is it important to track these asset classes?
To track the value of what?
Yeah, why is it important to track the value and the prices of stocks, bonds, oil, gold, and the value of the U.S. dollar compared to foreign currencies? Why should you be tracking this stuff every day?
Because you can use the forex markets to hedge currency risk.
Okay, that's one. But why are you tracking these things? Why is it important for you to track them?
To understand the strategy of money.
There's that too. But what's the most important thing? Why are you tracking these asset classes? Why do you care about them?
So you can make predictions on it?
Yes, but there's something that's even more important. It's even more important for you and your clients.
Diversify your portfolios.
Well, there's that, but there's something that's even more important. Because there's trillions and trillions and trillions and trillions of dollars that basically move in and out of these asset classes every single day, all across the globe, 7 days a week, 24 hours a day. The majority of wealth held on a global basis are in these 5 asset classes. majority of your wealth, your family's wealth, are in these major asset classes. So you need to be tracking them, you need to understand them. Because if you're not, you're totally naive, and you're violating your fiduciary responsibility to your clients. And you're violating the fiduciary responsibility to your family. Because you're a finance major, you should be following this stuff. Because you're gonna be managing this stuff, you're gonna be making recommendations on this stuff, and your job is to accumulate wealth on behalf of your clients and your family so that they can live a very high quality life for the rest of their lives. Okay? So there's a lot to this. Where are these asset classes trading today? Okay, let's do it. So we got stocks, we got oil, we got gold, we got bonds, and we got USD FX. So where's the Dow Jones Industrial Average right now?
23423, or 29423.
29434?
29423.
23. Got it. Is it up or down?
Down.
Okay. Down. Got it. Some direction. Level. Got it. Do we know how much?
43 basis points.
Yes, 43 BPS. Got it. You can put in the percentage change or whatever it is. You can trend it on a weekly, monthly, whatever. It's just are you following it? And then do you know why? What would cause the stock market to go down?
Coronavirus fears again.
What?
They're the coronavirus fears again.
Yeah, so, is it rising interest rates or lower, earnings expectations? Right?
Mm-hmm.
So this goes down, this goes down, this goes up, that goes down, okay, so. Lower earnings per share expectations, either on a dollar amount or percentage change, and then maybe higher interest rates, or higher risk in the market. Do you know what's driving these asset classes up and down? What about oil? Where's oil?
5140.
5140, is it up or down?
Down.
Down by how much?
4 basis points.
Why?
Demand for oil is expected to decrease.
Yeah, so lower demand, right, due to the coronavirus, trade tensions, what else? Well, China's not producing anything, are they consuming oil?
Yes.
No.
Oh, really?
Oh, no, they are not current.
So if they're not producing anything, because basically the manufacturing plants are shut down and they use oil to transport and ship and, use, oil, coal and stuff to, to produce that stuff, what's gonna happen to the supply of oil?
Goes up.
It's gonna go up, and what's gonna happen to the prices?
Goes up.
So higher supply. Are you tracking the markets? Where's gold per ounce? Where's gold?
1578.
Up or down?
Down.
What? Is it up or down?
Down.
Is it trending up or down? It could go up and down in a day, but really what's been the trend? Is it up or down? It's been trending up?
It's been like pretty flat.
Yeah,
Flat.
yeah, it's been pretty flat, right? So if it's been pretty flat, what does that tell you about inflation expectations? Relatively flat. What does that tell you about geopolitical risk? Relatively stable. What does that tell you about devaluation of your currency?
Highly
No,
unlikely.
yeah, exactly. So those are all the factors. So it's basically flat, right? And basically relatively stable. There's not a lot of fear that's pushing prices up. Interest rates aren't going up, which would cause them to go down. Interest rates are, inflation is muted, which is actually, if inflation was going up, gold prices would go up, and if inflation was going down, gold prices would go down. So you can kind of write some stuff in here. Where's the 10-year treasury yielding?
161
1.61. Is it up or down?
down,
Down. By how much?
80 basis points.
80 BPS over what period of time? Like a couple of years or something.
Over what? For,
80 basis points that it dropped over what, like a 6-month period or something?
that's just what it closed at.
Yeah, but 80 basis points, I mean, it's at 2 something, right? I think it dropped like a basis point over the last 24 hours.
Yeah.
But the question is the 10-year treasury yielding trending down?
Yeah.
Yes, so if it's trending down, what's the inflation expectations? Down. What's the future growth expectations? Lower. What's that gonna do to the stock market?
Slow.
Can cause it to go down, right? These asset classes are also related to each other, okay? So inflation expectations, and GDP, right, lower, higher demand for bonds, right? Bond prices go up, interest rates go down, so you give me the reasons. So where is the dollar to the pound, dollar to the euro? It's like what, $1.30, right, for the pound? Is that right?
Yeah.
And then what's how much does it cost to buy a euro? Is it 1.1, 1 point, what is it? How much does it cost for me to buy a euro? Get on your computers. I need the data.
1.8.
1.08. Got it. Okay. Is it costing me more or less to buy a pound than a euro over the last couple months or couple weeks? So it's less. So basically the dollar is what? So basically this is going down by some amount. I don't know if you can figure it out. So if it's cheaper for me to buy the euro and the pound, has the dollar appreciated or depreciated? Appreciated. Dollar appreciation and FX depreciation. So, higher interest rate spreads in the United States compared to other places. More stability here compared to other places. The anticipation of recession in other parts of the globe compared to the United States could cause these effects. So that's kind of what I'm looking for that one, is that table. Okay? All right, so that's that question. And then I'm gonna save the next two and the others. And we'll work our way through this. So we'll start doing labs and we'll start finishing this up. Okay? Because I want to walk you through this stuff. This stuff's really important. And I don't want to spend all class on it. I want you to give you lab time next time to work, on the projects. Okay? And then we'll finish this stuff. Okay? All right. And the memos. I'll take a look at them. Just put a little square space right there. And then don't use have been. See if we got some squares there. Some people that are now. Average is on an upward trend. Okay, so use present tense and future tense. Okay, don't use past tense. Students use past tense. We use present tense. The current national unemployment rate is 3.6%. You don't need that. An unemployment rate, as unemployment remains low, wage growth to accelerate.
Maybe that back actually.
And is expected to drive up consumption, Yeah, something like that.
Yeah, okay.
I'll sit down with you. And then you say Fed chair. Is that like his nickname? Fed? It's not Jerome anymore, it's, hey, Fed.
You know what, actually, yeah, I think that's what I heard.
Yeah, so he's got this cute little name now.
Jerome.
Fed Chair Jerome Powell is maintaining
Okay.
low interest rates to
I
stimulate.
didn't really give it a second look.
No, that's okay, no, I'm just walking you through.
Okay.
So, you know, give me these, and then what I'll do, I'll correct them. I'll come around and correct them with you. So I'll show you how to correct them and turn them more active voice, you know, more persuasive. Okay? And then, okay, you need a title on that graph. Okay. I think your graphs need to be a little bit bigger. Okay, anybody else want to show me some? You're ready to do oil and wall and stuff. Oh, you have your numbers too? Your bullets, two bullets are too big, and you gotta move these over so that you're not wrapping right there. You need the space in between this and the tip, you need space right there. You need to bold that, you need to center, your graphs need to be bigger, move this over, more data. Where that space, in between, you guys are working with this. Needed space in between here. Space here needs to make these graphs a little bigger and narrow the margin up here, center this or that. Get rid of the number one. Okay, see you later. And then move this over, make the graphs a little bigger. Keep them out of the large. Hold these right here, we get rid of that space right there. And then that needs to be a graph. And that needs to be a curve. And then these are the wrong values. These are correct, but these are wrong. So these are 5 by 9. Okay? I do right there. Okay, your bullets are too big. Make them small. Okay, bold. Have space in between the here and the. These are all, and it's, I'll take out the S. It's short, not short. And that's above. Okay? And then put a space in between these. And narrow the top margin and get rid of it. And I'll read it. It's either the above 36. So it ties back to the above. The other one's the following the above.
So we want to say these are
Yeah, correct. And then you need all those spaces. And then these holes need to be bigger. You need to have holes and space in between these. And then narrow the space up here and go. Make these graphs in the answer. Make sure that this is at 12 or else at 13. And then I'll read it. So kind of work on the formatting. If you want to go ahead and do this, make sure this is and you need periods after you move it. Then right justify these to keep these over here and bold. Correct. Good. And then make these a little bit bigger. And then make that all. Yeah, take that. You're ready to do
What?
So
I
make sure the graphs are matching each other. You're ready to do it. It's right just.
Yeah, but there are some labels up there that have like apple.
Here.
Oh, okay.
Oh, you want it all these in order?
Yeah, it's right just. Keep those like the left side right
Take over the left side.
So yeah.
there. And then everything else.
Okay, so that's
So do you want to how much why you choose?
Huh?
Why
Yeah,
you
let's just correct it right
choose
now.
top these
So then again.
here?
Oh, you can narrow that
I'll
too,
catch
just
it.
so you don't go to 2 pages.
So yeah, I
Yeah, put a space in
highlight and then
Move the tickers over there and hold it right there.
and then find some, exchange traded funds.
Oh,
So get
right,
rid of
yeah.
those right there. Cause you already have it, here, you don't need it there.
Wait, sorry, I don't need the.
You don't need the trades there and there, cause you already have it here.
Oh, okay, so, okay. so I can-
And then you have to have stock prices forecast to rise 3%, 10% over the next 3 months, that needs to be that, get rid of the.
Oh, so we should do
quotation
well.
marks.
Okay, right,
Okay, and then you have to see this.
okay.
Let me check the trades. So your forecasting it to go up,
Yes,
okay, so that's gonna be buy by
Oh,
right,
right, so the spacing is.
Okay.
buy by right, buy by right.
okay,
So that's cool.
How much is that?
And then, narrow the top and the bottom margins so that all goes in one page.
okay,
And
yeah.
you can kind of narrow the side margins too.
Okay, perfect,
And you
okay.
can start on the loyalty.
Alright,
And then put some spacing in between these,
The line.
the bullets. Make sure it's one line spacing.
Oh, yeah.
Put a line spacing there. Make sure it's in 12 point. And don't have the conclusion here wrap around the graph. So you're gonna need to narrow.
It's gonna be on 2 pages.
No,
Soon
so
as
you
we-
narrow the top margin and the bottom margin, and
Okay.
it'll fit. And goodbye, thank you. And you have stock prices forecast to rise by 5% over the next 3 months, an upper lower case right here,
Okay.
okay? And make sure everything's in 12 point. And then get rid of those trades and those trades right
Just
there.
have one basis.
Yeah, just right here. And then you need to find, there needs to be, it's gotta be 335. So 12, 9, 15, 36.
Well, you said get rid of these.
Get rid of that and that, because you already have it there.
I got you.
Got it, and then bold that, and right justify these tickers in the cell. And then capitalize the T and use the right and bold
Okay, and if you want 3 for each of these?
it. 3 for these, 3 for these, and 5 for these. And just put the other one on the, underneath, right there,
Yeah, yeah.
underneath the
I
C.
got you.
And then put a space in between the graphs, and make sure it's 12 point,
Okay.
okay?
Okay, wait, so how, so,
Can you work with him on these memos?
Sure, yeah.
Because he's got a lot of formatting.
Okay, yeah.
So work with him.
16
And then did you have something?
Yeah, so
I
like the
didn't-
structure is.
Is it 18?
Yeah,
Is it still one page though?
yeah.
Go in and go to paragraph, and
How
get
do I
rid of
change
the
the
format.
spacing? Instead of it's 2 pages.
Just like
So it makes
5
it all
in
tighter.
between,
If you go to
Put some space in between
like,
this
Literally
and
like this, like
Yeah.
this?
the text.
yeah,
Okay, narrow the top margins.
that's how I use it.
And then put some data in here. Find some data.
Yeah, it's
And then I'll read it.
Oh, is this
And
spacing?
then make these bullets a little bit smaller. Don't make them small.
That's it?
Yeah, I center it.
Like,
Anybody else?
yeah. I know you went over mine, but, you said